So we said we're treating cash flow today. And I think it's simple. We want to start with simple cash flow before we go into group cash flow. Because the essence is that we should be able to have an idea of single entity cash flow statements. And then for those of the corporate, of the group financial statement. So cash flows are governed under IAS 7, which is statement of cash flow. Definitely, we know that cash is king in every organization. No matter what we declare as profit, the most important thing is this company liquid in terms of cash? So that is how important statement of cash flow is. And because for me, the way I teach statement of account, I tell my students that if you have ever done reconciliation statements, then that's what we are doing here. A cash flow statement is a reconciliation statement. What are we reconciling? We are reconciling two areas. What are the areas? We have one. We have, because the essence of preparing income statement is to arrive. Is for us to get to profit. But we have cash, which is the other extreme. So how do we tell the non-accountants that there's a relationship between profit and cash? For every shareholder, we want to ensure that our company is liquid, even when they are profitable, because we have seen companies that have declared profits. Afterwards, they file for solvency or liquidation status. So there must be a relationship between profit and cash, and that relationship is settled in cash flow statement. So when we are going to walking through how profit and cash are related, what causes the difference between profit and cash, that is our statement of cash flow. That is a summary of statement of cash flow. So, usefulness of cash flow statement, we'll read them up. We have three different activities between the action of profit and the action of cash. Those three major activities are responsible for the differences between profit and cash. Those activities are summarized as operating activities, investing activities, and financing activities. These three activities are responsible for the difference between profit and cash. So our job here is to teach you what are contained in operating activities, what are contained in investing activities, and what are those contained in financing activities. Once we can know those three things, we are good to go. So I'm not going to be defining cash to us. Cash is bring out money in your wallet. Check your wallet, whether you have cash. That is cash. That is cash on hand. No need to define cash. However, let's understand the components of cash. So we said cash and cash equivalents. So I will be teaching you the equivalence of cash. When we say cash in hand, it's cash in your pockets. Do you have it in your pocket or in your safe in your office? If it's not at hand, then it is in the bank. Then if it's not in the bank, what are those things that we consider in accounting or in the finance world that are close to cash? We said highly liquid investments. These are investments that if I want to sell it today, I will just call my stockbroker and say, please help me hail this my shares. And they will go to the market and order it and it will be sold. We call it highly liquid investments that are easily convertible to known amounts. So if I see that shares is 10 naira per share and I have 1,000 shares, I already know how much I'm expecting to get. Known amount. and they're actually subject to insignificant risk in changes in value. We also have equivalents of Naira, which are foreign denominated currencies. Foreign denominated currencies are as good as cash, because if you have foreign denominated currencies in your bank account, you are going to hold them in your financial statement in Naira equivalent. So they are equivalents. They're one of the examples of equivalence. And how do we describe? Usually, we use terms, number of months, to measure investments that are highly liquid. We said investment that have a not more than 3 months investments. So you buy a treasury bills that you're going to liquidate in the next 3 months. So we said these are highly liquid. So usually short-term investments are regarded as near cash and as good as cash. So when we are computing cash in cash flow statements, when we are trying to reconcile profit to cash, what we are trying to do is we are trying to reconcile profit to cash at hand, cash in the bank, equivalent of foreign denominated currencies, short-term deposit of 90 days, as well as overdrafts. Because what are overdrafts? You want to pay salaries, but you don't have money, you go and collect a 3 months or 1 month overdraft in your bank. So when you see overdraft in financial statements, those overdrafts are liabilities, usually under current liabilities, which depletes the summation of cash. So if I say cash at bank, cash short-term investment, and I add overdraft is going to serve as a deduction in my summation. I hope that is clear. Yes, it's clear. Now, in trying to analyze operating activities, we have 2 methods of representing operating activities. We can either represent operating activities using the indirect method, or we can represent operating activities using the direct method. Now, what are the indirect methods? The indirect methods are in the format as above. In your screen, you are seeing that these are examples of what we call indirect method. 1, you start with your net profit before tax. Your aim is to arrive at cash from operations. Cash from operations. So you want to reconcile from profits to cash, but in that journey, you are going to first of all analyze operating activities. In analyzing operating activities, you have 2 methods, indirect and direct. Now, what we have on the screen is indirect method, which I'm explaining. So you start with the net profit before tax, and you make adjustment for 2 important things. 1, finance costs and investment income. Finance costs, as we know from our standards, finance costs are usually interest costs. If you have a loan in your bank, or you have issued debentures, you pay interest costs. These are called finance costs. Now, why do we reverse them at the first line item? I will explain. We said adjust because finance costs, for the fact that we have recorded finance costs in our financial statement, we may not have paid the people. And our interest here is that everything that is not cash should be reversed in our reconciliation journey to cash. Things that do not result to cash transaction, we are asked to reverse them in operating activities or get the cash element that is embedded in that transaction. So finance costs, at the first level of seeing finance costs, we are to reverse the effect. So what is the effect? When I say reverse, finance costs naturally gives us a negative effect on financial statements. So you have your profits, you have interest costs, which we deduct. So if I say reverse, I mean add back. So if it's what, if you have 500 there before, you add back 600, you add back 500 back. So you reverse it. Now the essence of doing that is want to be careful. So first of all, we reverse whatever we have seen as finance costs. We reverse whatever we have seen as investment income. These are activities that may not be cash, but can still be cash. So for us not to confuse ourselves, we need to first reverse it and go and check the additional information. If after adjustment of finance costs as a ledger, does it result to a cash payment or a non-cash payment? We will see those demonstrations. So to play safe, reverse them at the first instance. Then we now said after you have done that, you would have adjusted your profit to what we call profit from operations. Then we look at what we call non-cash items. If you look at this category we have here, we call them non-cash items. These are items that does not necessarily result to cash movement. So non-cash items. What are non-cash items? Depreciation for sure is a non-cash item. So what do? We add back. So here we are reversing whatever we have done in the income statement. It's very important to understand this format. I'm taking time to explain it. So that when we go into workings, it's a done deal in understanding what we have done. Now, what am I doing here? We are adding back, or we are reversing the effect of all this that has happened in the income statement. Depreciation is usually a deduction in the income statement. But in the depreciation, we are saying it's not a positive because we are returning it back. We are saying, no, this expense is not allowed. We are returning it back as a positive. That is why it is without a jacket. Profit on sale on non-current assets. Let's make sense of what we are saying here. When we say profit of sale, let's say you have a PPE that has a balance brought down of 500, but you sold it. So there was a cash sale. So you made a cash sales of 1,000 naira. What will happen to your bank? In your bank, the money will arrive as PPE 1,000 naira. But we would have gone ahead to say profit on sale on 500. Isn't that what we do in financials? This is what we do in our financials. So we have a line item called profit on sale of non-current assets. We are saying as far as that name called profit is concerned, it is a non-cash item. You know why? Because the cash item have been recognized in the bank statements. The cash element that is important to statement of cash position, statement of cash flow statement has been recognized in our bank. Therefore, why do we now replicate profit again? We are not saying reverse it. So profit on the sale of non-current asset is reversed. That's why you see that jacket there. I hope you are following my explanation. Oluwatoyin, are you following my explanation?
Yes, sir. About you.
Oluwatoyin, why did you quickly off your video?
Sorry, I don't know that.
Why did you quickly off the video? I was looking at your face. Now I went to off the video. So did you understand what I'm saying?
Yes, sir.
Okay, fine. Now, another item we look at is provisions that has to do with increase or decrease. Remember, I demonstrated this last week when we did final accounts, where we had an increase or decrease in for those in FR, sorry, this is a combined class. For the FR students, we did increase or decrease in allowable provision for doubtful debt thereabout. So those increase or decreases are not cash element. Therefore, we reverse them. So if your financial statement there was a decrease, it means your income, money is coming to your income. You reverse it. It's not cash. If the increase is going up, it means that you are recognizing more expense. And you would have done the deduction in your income statement, but in your statement of cash flow is a reverse of what you have done in the income statement. Likewise, government grants amortization, which is like depreciation, increase or decrease in prepayment, increase or decrease in accruals. These are purely non-cash items. We are saying reverse the effect. So if you had an increase of accruals, which will result to more expense, you reverse it by making it positive in your statement of cash flow. Good. Now, after that cadre of non-cash item, we have what we call working capital changes. Now, this is most interesting in statement of cash flow. We are saying that as we are looking at our non-current assets, there's a movement in it. That movement is not shown in the income statement when we're preparing financial statement, but that movement will be exposed when we are doing statement of cash flow. And we will use those movements to tell ourselves whether we have an increase in cash or decrease in cash. Let's use a very common example, receivables. Receivables is usually a debit entry. So let's assume we have balance brought down, let's say 1,000 here, receivables. Within the year, we collected, we have payments of people who were owing us to the extent of 500. Then at the close of business, we have balance CD. We have 2,000. Now, what will be given to you in your financial statements, you ask yourself, given this figure, okay, let's even assume that we don't have even have a payment. Okay, let's try to, what's the missing link in this figure? What is it balancing? What make it balance?
The additional receivable in the year.
So if we want to close this account, we have 2,500 here.
Yes.
And the difference here is 1,500. Am I correct?
Yeah.
So this is a missing figure. And we are saying, given this missing figure, what has happened to our cash? What's the effect on our cash? That's the question. Is our cash better off? Is our cash position better off or worse off?
It's worse off.
It's worse off because we have got to give, like now, some people are still owing us. We are rendering services. Our cash position is bad. I'm shouting, and they're not answering me. I hope this example is clear.
Somehow.
You mean it's worse off because you have not. It's worse off because you've not received the money yet, or
no, it's worse off because I cannot do what I'm supposed to do with cash. Because I'm giving you credits. Do you get?
Yeah.
So if my cash is supposed to be, let's say my cash position is 1,000, but if I didn't sell on credit, I would have had 1,500. Am I correct? Cash. But because I have sold on credit, therefore I cannot have a channel 1,500. I'm only having 1,000 naira. So I say my cash position is worse off. Am I correct? So we call it the effect in changes in working capital. Because your working capital are the things that turns your investments into cash. Your investment is turned into cash at working capital stage. So when you get your working capital management wrong, you're going to have a cash problem. Any company, you're going to see symptoms, you're going to study symptoms. any company that does not manage its working capital very well is going to have serious cash problem. So because this is where you are turning your investment into cash. So your receivable, for now, that means in this question, in this format, this negative is our case. This negative is our case. My cash position is reduced because my receivable has gone up. Am I correct? So I want to, in your notes, you will see a format that an increase in assets, in working capital assets, an increase in working capital assets will lead to a decrease in cash position. So I don't want you to cram, but I want you to reason it out that if I do increase in working capital assets, will give you a decrease in cash. You will say, oh, how manage? I've explained it using this ledger. So which one do you prefer, the explanation or the cramming?
You too.
Both.
Both of them.
Abibat.
One will save you at the end of the day.
Forget the cramming. Folk, do you know why? They can tweak this. You can have done questions, you could have done 5 questions with an increase in working capital. And when you now change the dynamics and bring a decrease, you shouldn't be confused once you understand the theory. That, okay, what I'm trying to achieve here, my working capital is going up. Therefore, I'm not getting the cash, and to reduce a reduction in cash. So that is the sense I want to make here. So usually we don't do the ledgers working capital. We only compare. It will give us our financial position. We compare the open and the closing to see whether we have an increase or a decrease, and we now determine whether it is a cash effect is positive or negative. Now, for liability, if I don't pay my creditors, so if I have a liability of 1,000, say I'm owing bank, if I'm owing UBA, for instance, 10 million naira, and in my loan account, you are still loan 10 million naira. I went ahead to collect, I collected on that first bank 5 million naira. In my loan, it turns to 15 million naira. Am I better off in cash? I'm better off in cash.
Yes.
So my theory would not change. That an increase in working capital liability will lead to an increase in cash. It's not confusing. I've just explained it. The more you don't pay your trade, you don't pay your creditors, the more you're better off is your cash position. That's why you say, pray for those who are owing you.
That means
leave.
it's not good to be paying on time with that.
Yeah, that is why America is the highest debt. Yes, for. Use the money and yeah, it's for me working. You should be able to. That's what we call debt capital management. You need to owing money is very good. In fact, a part of finance theory that encourages people to borrow. You know why? When you borrow, your managers they become better off because they become stringent in their management tactics in order to save money to pay the debt. But when a company has so much cash in possession, they'll be careless. Hello?
Let's come and borrow me money or Gauchi.
Fuel at 1,000 naira, right? Okay. So when we do all those adjustments, it will give us what we call cash generated from operations. So the net effect of what we have done so far is going to result to cash generated from operations. Now, I've made explanation of all the headers I'm going to pass through now. So if you have your material, you go through it after. I've explained the effect of depreciation. I've explained disposal of non-current assets. I've explained changes in receivable. I've explained all this. So you read them up. Now, direct method. Direct method. Well, this network is bad. It's blessing.
It's mine. No.
Just mute yourself.
Yes, sir.
Okay. Okay, so it's direct method. No, direct method now is telling us what are those things. Look at these 3 or 4 items there. I still want to arrive at my cash from operation. Remember, I used indirect method, and you saw the long format in which we came down to cash from operation. I will still arrive at, so if I use this is direct method, if I use indirect method and here gives me 1,000, I will still get 1,000 here. But how I arrive at this is different from how I arrive at this. That is just the method. So as far as statement of cash flow is concerned, the activities within the operating activities can be either through direct method or indirect, but end of the day, you have the same cash generated from operation. Now, focusing on direct method, we said cash received from customers. I just want to know, I'm not dealing with anything accruals. I just want to know how much have my customers paid me? Chikina? My suppliers, how much have I paid them? All this accrual, I don't want to hear it. Cash paid for on behalf of employees and other cash expenses. This is where we only do a lot of adjustments. Now, after that, you are going to arrive at cash generated from operation. Now, that means that investment activities and financing activities are the same. There is no method, there's no difference in method when you come to investment and financing activities. So where you disturb yourself or where you to know the difference is only in operating. Yes, I can hear you. More should. Okay. Now, where you need to disturb yourself lies within the difference between direct and indirect in the operating activities. Good. We move. So we try to bring direct method and indirect method. As you can see, end of the day, we have 3278 for both direct and indirect method. This is just a sample to show us that there is no difference. Now, in the question remains that if you check your income, remember they're going to give you income statements. They're going to give you 2 years financial position, 1 income statement, 2 years financial statement, or sometimes they even give 2 income statements, 2 financial positions for you to know, so that they will try to confuse you whether do you know where you are supposed to pick or not supposed to pick. Now, if you look at those income statements from head to toe alone, you may not be able to pick cash received from customers without you doing an adjustment. You won't be able to pick cash payment to suppliers without doing an adjustment. So you can't do any of the direct method without doing an adjustment. Therefore, we have these formats below in order for you to deduce cash from customers and cash paid to suppliers. Now, what do? We pick trade receivables. Now, from our trade receivables, we tell ourselves, what's the opening trade receivables? You have it here. What's the closing trade receivables? We have it here. We now go to the income statements and pick the sales for the period. We put it here. This is incomplete. We call it incomplete method. I'm sure everybody at this stage must have done incomplete records. They would have taught you in your 100 level, 200 level, or your foundation class. Through the knowledge of incomplete record, you can deduce the missing figure. The missing figure is what you are arriving at, which is this. And in your ICANN exam, when they give you these questions, all these missing figures is what carries the highest mark. The ones you can deduce directly, it does not have highest mark. It is the one that you need to solve for them to test whether you actually know your indirect methods. So this gives you your cash from customers, which you're going to do by T account. Okay. So that's followed for payable. Advantage and disadvantage of cash. I'm not going to read that. If you don't have money, you know. If you have money, you know. So I won't tell you advantages of holding cash. And end of the day, we now come into investing. What are those things that sit in investing activities? And from the name of those things, we will reason that actually this is investment. This is financing. Now, when you hear the word financing, let me start from there. When you hear the word financing, what does our mind speak to? It tells you that somebody is helping you to run your business. I want to recognize money that is coming from somebody that is not my own money. Now, look at the items under financing. You relate it to what I'm saying. Proceeds from the issue of shares. Now, every bank, they are all issuing shares. What are they doing? They are asking you to please borrow them money. Sure, we know the meaning. Borrow them money. Either you dash them money or you buy shares and they'll take your money and issue you shares as an equity holder. That is proceeds from issue of shares. We go to the bank to collect long-term borrowing that exceeds more than 2 years. We have payment of lease liability, because lease liability means that you are paying lease into a very long future. That's a form of financing. Now, I want us to draw the difference between, okay, I have it here. Let me put on it's on the face of the screen. One, we have what we call interest. Please note, this could be interest received or interest paid. I'm going to explain it from the name here. We also have dividend received or dividend paid. I'm going to explain it just on the face of the account. Now, let's not speak to interest received, because these 4 elements, there are 4 elements now. Interest received, interest paid, that is 1, 2. Dividend received, dividend paid, 3, 4. Now, interest received is speaking that you have done an investment. I have gone to buy Sukuk bonds or Euro bonds or dollar-denominated bond of government, and they are paying me interest. What resulted to me earning that interest is that I have done an investment. So it is only natural for interest received to sit in investing activities. I hope it's clear. Yes. Now, the confusing part is interest paid. Interest paid. Now, looking at it, when I issue debentures, I issue convertible loan notes, or I issue a loan note, I'm asking people to borrow me money into a long-term period. I pay them interest. Hello, I pay them interest. Therefore, that is one level. 2, I can also go to the bank to borrow money, and the bank charges me interest. It is still interest paid. I'm paying interest. Now, I'm emphasizing the same thing in 2 different dimensions. When somebody gives you money in form of long-term borrowing, when somebody gives you money in terms of long-term borrowing and you pay interest, that interest in respect of long-term borrowing can conveniently sit in financing activities. Am I communicating?
No.
Okay, what's confusing? Tell me. Who said no? Musaka said no. You don't
Yes.
understand the confusion.
You said interest paid on loan you received. You put it in investing activity.
No. What I said was, I only completed these 2 things by adding receive and paid. I'm not putting them into this. Okay, let me take it outside the table. This is outside the table now. I said interest received. This is interest paid. This is dividend received, and we have dividend paid. Do you understand now? I'm
Yeah,
taking
yeah.
it outside any of this class now. I'm speaking to them individually.
Yeah.
I have told us about interest received. The interest received is because we have done an investment. Money is coming in, is it not? That is
Yeah.
natural for it to sit as an investing activity. Be clear?
Yes.
Good. And now go to interest paid. I say interest paid can sit in two places. One, it can sit in financing activity. It can also sit in operating activities.
Okay.
And I'll try to draw the distinction that when you borrow money to finance your company, which is a long-term borrowing, and you are paying interest, that interest you are paying sits in the financing activities. So it will sit here. When it is related to what? Long-term borrowing. Is that clear?
Yeah.
But when that interest paid is relating to short-term borrowing, like bank loan, which is just for operating activities, that sits in operating. That is our finance cost. I hope it's clear.
Yeah. Crystal clear. Thank you.
Okay. Now, we now said dividend received. Dividend received because I have also done an investment. I've bought shares in First Bank and they are declaring dividend. They pay me dividend. That is resulting from investing, and that sits in dividend received. Why dividend paid is that the company is the one that have issued shares. Note the two things. So in dividend received, I bought shares. They are paying me dividend. But in dividend paid is that it's you that issue shares. Therefore, you are the person making dividend payment to others. That sits as a financing activity. Clear? Clear. Okay. It's very important to understand these basic distinctions, because cash flow could be a little bit confusing. But I think it was it last diet or last two diet, they set cash flow as number one question. And it was like, how? I say, Is it not part of your syllabus? Said that number one question will be preparation of financial statements. There's S at the back. Then that means they can ask you income statement, they can ask you financial position, they can ask you group, they can ask you statement of cash flow. It's part of financial statements. Good. So don't say that you're taking unawares. Now, when we have done with the summation of operating activities, remember operating activities is coming from here. You can see the total of our operating activities is coming from the adjustment all the way from profits to here. Then we now add the changes that had occurred resulting from investing activities. Those changes is also added in the line. For this format is here. Then financing activities total is here. So end of the day, we have operating plus financing plus investing. The total changes is called net increase or decrease in cash and cash equivalent. So let's put a figure to it for understanding. Assume we have 2,000 here. End of the day. Now, I want to prove to the non-accountants who say or who claim that accountants are doing wayo that profit, I can give them the journey between profit and cash. Now, after I've arrived at all my adjustments, I get 2,000. I will go and pick my opening cash at the beginning of the period. Let's say it's 500. Automatically, my closing balance is the net changes plus my opening, which was giving my closing. So I have 2,500. If I go to my financial position given to me in the question, and I sum all my cash positions, note the S at the back, my cash positions, I must have 2,500. If I don't have 25, then this adjustment is wrong. Then I need to go up the ladder again and check where I've done something wrong. So if you are going to get 100% in cash flow statement, you will know from the whole, because the answer you're looking for is given to you in the question. The financial position you are trying to arrive at is given to you in the question. If you are wrong, you know. So if you don't need to go and do Thanksgiving, when you know that the team did not give you your cash, so you will now be praying that God do anyhow, let the others be good. Let the others be good. And anyhow, 50 is 50, 50 is 50, anyhow, 50 is 50. Because you know the whole. Now, how do I get my cash positions? Remember I said you have to sum up your cash positions at the end of the period. Now, for the fact I said end of the period, I can also have a different sources of cash positions at the beginning of the year. Therefore, what's my previous year, 2022? What's my current year, 2023? I want to determine my cash positions. So I go to my financial position. I go and look at what the financial position says is cash on hand or cash in bank. I put it here. Whether it is positive or negative, I put it there. So if you have an overdraft, hello, if you have an overdraft, that is where it comes in here. An overdraft will come in as a negative because cash cannot be negative. What is responsible for negative cash equivalent is overdraft. So if you have cash at 0, you now go and check your overdraft in your current liability. You see overdraft there, pick it and put it in this format. That will be the negative. You go and look for, if you have cash, fine. In some questions, you will have cash. Let's say cash is 500. You will not see have overdraft. Again, the same question. Overdraft is 300. You put jacket. I hope I'm communicating. Yes. You now have short-term investments. Let's say 1,000. If I tell you what is my total cash equivalent, it is 500 minus 300, which is 200, plus 1,000, which is 1,200. Clear? Clear. Any question? No question. So you do this for both 2000 and for both the previous year and the. So if I have total of this and I have 1,500 and I have 1,000, it is this 1,000 I'm going to add there. Then by the time I sum it up with my balance of 2,000, I have 3,000. If this 3,000 here does not equal to this 3,000 here, or more, I'm wrong. Clear? Wrong. Something is wrong. But let me encourage you. Let me encourage you. They are marking posting. They are marking your entry. So sometimes when you are close to time and pencil up, be bold enough to walk out of the hall without balancing it. Because some students have made a mistake. They'll cross their work. And maybe what they're looking for to balance is just 200 naira or 400 naira. They've cancelled 90% of the work. And they don't have time to continue. That one is village people well prepared for you. Okay. Don't cancel your work until you have reproduced what you have done before and corrected before you can cancel conveniently. Now, I've told us that we're going to use, now, on that rule of thumb, I advise my students, if you are very matured in accounting, if you are very graduate in accounting, you can do what is demonstrated in this material. Under this screen, you know, you want to tell them that I don't do T method. I actually know the flow. What do? You do interest, balance brought forward, pick your finance costs, then get your balance paid, your carry forward. The difference is this. If you are not sure what we are doing here, do this. Adapt my student in the face of ICANN exam. Do this to reduce stressing your brain on how to counterbalance the ledger in your mind. Do your ledger. You know, interest liability means in your current account or in your non-current accounts, you have interest brought forward, which is the opening interest from the previous year. So let's put figure to this. Let's say this is 2,000. So balance brought forward is 2,000. I go to my interest liability for the end of the year in the current financial statement of the period, balance CV. I have 3,000 here. So if I have 3,000 here, then I go to my income statements. Like I said, I want to advise students, whenever your adjustment is more than 2, please use a T account to know which side is your shortfall or the SS. Let me explain. I said this is 2,000, this is 3,000. You go to your income statement, check the finance cost there. You see for the year 2,500. So my P&L account, I have 2,500 here. So I want to close my financial statements, my ledger rather, my interest ledger. If I sum this up, now I know that the credit side is higher than the debit side. What will happen here? I have 4,500 here. Minus 3,000, I have 1,500 here. Am I communicating? Now this 1,500, I don't know what it's called. But let me tell you what it's called. For you to know what it's called, please, in your mind, in your imaginative mind, imagine a cash book. So I'm not saying to draw it because you are in skills and you are a professional student. You don't need to draw it. You need to imagine a cash book. Our cash book has a rule that all money coming in sits here. Am I correct? And all payments sits here. I'm correct. Now, every ledger that you are preparing in this statement of cash flow that is not a cash book means that in the cash book, it will take the opposite of it. Now, if I'm to, because the essence of cash or statement of cash flow is to know how your ledgers have impacted your cash. Therefore, since I have a missing figure called missing, which I have derived, we call it derived. 1,500. For me to know the impact or where it should sit in the cash book, it means that if it's on the debit side of the ledger called interest, if I'm to counterbalance it to the cash book, it's got to come to the credit side. Who remember this? Interest 1,500. This is cash. Am I correct? 1,500. This cash is the missing cash that was paid in cash, but was not, because of accrual concepts, we don't recognize this in the income statements. But because of statement of cash flow, we want to bring all cash elements, all cash movements in the different ledger accounts into the cash book to determine our indirect method. Therefore, the missing ledger is 1,500, which we have derived. Now, I've said it is called cash, but the kind of cash it's called we derive the name from where it's landing in the cash book. For the fact that it's going to the credit side of the cash book, therefore it is cash paid. If I come to my statement of cash flow, I'm going to have interest, 1,500, jackets. Who doesn't understand my analogy? Please unmute and ask question. I'm not in a hurry to solve question. No. You see, this explanation is key to understanding what we're going to do by when we are solving questions. Very key. If you don't understand what I've just illustrated, please unmute and ask.
So, in essence, this is now the interest paid, right?
This is not the interest paid.
1,500.
Remember, this interest would have appeared in your income statement as finance cost or interest. They will say 2,500. Why is it 2,500? It means that Assuming you have 100,000 naira loan, and you are to pay a 2.5% coupon rate. You know, automatically your finance cost will say it's 2.5, is it not? But have you paid? No. Even if you have paid, you won't see it in your income statement. But the adjustment that we do in preparing statements of cash flow that will reveal to us that your opening interest is 2,000, closing interest is 3,000. You have recognized additional 2.5 in your interest account. But if you're having a closing balance of 3,000, it's only natural. If for example, I have 4.5 here, and they're telling me that my financial position for the year is 3,000, it's only natural that I have paid something. Is that payment that must have reduced it to 3,000? Does that make common sense? Yeah, all right. Please, if you don't understand, ask question. Hey, Joma Binu, ask question. Okay, I like this class. I like this class.
Just again.
I didn't hear you, Oluwatoyin.
Huh?
I thought you were saying something.
No, I was just saying yes.
Oh, she was concurring that she understands everything. Lovely. So we're going to be doing those few adjustments for ledgers or for transactions that have more than 2 entries. Now, what I mean more than 2 entries, I'm speaking to this. I'm speaking to the fact that in your statement of financial position, I told us that they will give us 2 statements. So your statement of financial position, you have 2023, you have 2022. In your income statement for the current year alone, 2023. So I have interests here. I have a figure. We used 2,000 here. No, we used 3,000 here. Yes, we used 2,000 here. And we used 2.5 here, if I remember. Yes, so this is 1, 2, 3, all in the name of interest. Please, for you to bring out the cash elements, John, just do a T account on that ledger. The cash element will review itself. It will confess, here I am. Take me as a reduction in cash by being a jacket, or take me as a reduction in expense, being cash coming in. So your ledger can swing in any way. Don't tell yourself that normally now interest is supposed to be minus. So why is this one giving? If you know what you have done, just follow the sign and determine the cash movements. Good. So do this for tasks. Speaking to part of investment activities, we also do non-current asset adjustments. No, we have purchases of non-current assets. We could sell non-current assets. So all these adjustments will be taken care of in a T account. The most important thing is that understand any account you want to legalize for the sake of bringing out the cash position. Try to know whether that account is an asset account, 1, is a liability account, 2, is it an income account, 3, is it an expense account? Because it will follow the rule of the quadrants. Who can remember the quadrants? Who can remember quadrant to my students? Oh yeah? Quadrants. What is here? What is in 1? What is in 1? What's in 1 now, Benjamin? Accounting quadrant. What is in 1 now? This is ACC 101. I did it in 1999. That's why I did it in 101, 1999. What is in one?
Asset.
Asset. God bless you. What is in two?
Liability.
Liability.
That's a liability.
I hear you. What is in three?
Expenses.
Expenses
Income.
and income. Okay.
Yeah,
I know why, because it follows the rule of this. Debit, asset, debit, expense, credit, liability, credit, income statement. Simple. So if you pick any of the transactions, tell yourself which quadrant does it fall. This is an asset. An asset is must have an opening balance. So balance BD, you bring it down. If it's a liability, take it to the credit side and adjust. Because that is when most students make mistake. They'll go and carry a liability and start it with a debit entry. Or more, your account is already suffering, it's purging already. Okay. What are those things that could be financing activities? I mentioned it in my explanation. Receive from issuing shares, capital elements on these, and all those things. All these are adjusted, liabilities are adjusted. Dividend payments. Most times they don't give us dividend payments, but how do we know dividend payment? From movement in retained earnings. Because if I'm opening my retained earnings account, let me open retained earnings ledger. My retained earnings ledger automatically has a credit entry because it's an income element. So I have 2,000 here, balance BD. Profit for the year is 1,000. But they have told us that the balance CD is 500. And the only thing that can reduce my profit is dividend. So if I do my ledger, I have 3,000 here. I must have 3,000 to balance. So the missing figure here is dividend payments. This will never be given to you. You must derive it. And dividend paid will not tell you that dividend paid means that in our explanation, where does it sit? Financing activity or investing activities?
Investing activity.
Oh my shit. Benjamin. Dividend paid, where does it sit?
No, not in Benjamin. Okay.
Dividend paid means that you have issued shares and you are paid. It's a financing activity. Dividend received permanently sit in investing. Dividend paid sit in financing. Interest received currently sit in investing. But interest paid can either sit in financing or in operating. Clear? Clear. Now, in the spirit of trying to be considerate to the class, I decided not to solve any question today. We are going to stop the class here because we are all tired.
Thank you.
Calm down now, calm down, calm down.
No assignment.
Now, Jack PLC is a very long example. I will appeal. Don't miss next week class. Now, because in Jack PLC, if you see the question alone, you know it has brothers and sisters, even cousins. Now, we're going to solve Jack PLC. When we have solved Jack PLC, there is no other cash flow statement question as far as single entity is concerned that ICANN will bring that you cannot unravel. After solving this one, please go and pick any past question and confidently solve it. That is after you have closed your book and solved Jack PLC. Then you cannot pick one and solve. So once you understand this, we will do direct method. After direct method, we go into group cash flow, which is the concern of majorly of professional students. Nobody's going to ask you single entity. But for skilled students, they can still ask them single entity or group. But for professional students, forget single entity. But for the sake of refresher, For those that said, I have forgotten, please be in the class next week. We'll solve illustration 1, solve illustration 2, then move to group.